So joining us now from Jackson Hole in the great outdoors is our own Steve Leisman, alongside Anil Kashyap, professor at the University of Chicago's Booth School of Business. Steve, I'll send things over to you.
Yeah, and thanks, Tom, and thanks, Anil, for joining us. So we were just talking that we've known each other for a couple of decades, talking about monetary policy, but this is a fairly pregnant moment right now when it comes to the pivot. I want to know your thoughts about whether or not the time has indeed come.
Yeah, I think he handled it well because you didn't hear him say 50, right? He said it's coming, so he gave himself enough wiggle room to where I don't think he's going to get boxed into having to go faster than whatever the data look like in 2 weeks. But I'd be very surprised if we aren't at the beginning of, a sequence of rate cuts, and that seems pretty well warranted.
Why is it warranted? How do you look at the situation and say it's time to cut rates?
Well, I think the economy has slowed. I think the labor market is somewhat weaker, but still strong enough. And I think the trajectory on inflation looks relatively good. If I were them, I wouldn't have committed to say I have to get to 2.00. I would have tried to say we need to be headed towards it with, sufficient confidence, because, I don't think they'll be happy if after they've cut a ways, it levels off at 2.2. For me, that'd be good enough to declare victory. But, they thought that they needed to anchor those expectations right at 2, and they've put themselves in that box.
Right. So, Anil, you've studied this stuff for a long time, and I know that, economists don't get around to knowing what's actually happened until 3 or 4 years later. But Powell was pretty confident we're coming toward a soft landing, but that is not something the Fed has executed all that well in the past. Is there something different this time that makes you think there should be some confidence as they're going to pull this off?
Well, I think it's partly the way they got into this is we didn't understand all the forces that were acting in COVID, and it's clear that some of the retreat has been just a reversal of the stuff we didn't really understand. So I think that's been good. I mean, remember, markets were not expecting, in December of 21 that we were going to have to go anywhere near as high as we did, right. Nor were they expecting that we were going to stay as high as long as they have. I think they took a risk to say if it comes with a recession, we've got to get the inflation back in the bottle. It probably helped them. And I think there's probably been some good luck. I mean, if it had been a crummy weather winter right after Russia invaded,
right,
that could have derailed it. So
because the price of oil or energy would have spiked.
And yeah.
And what you said was really interesting. So if the source of the inflation was supply, and the supply goes away, you don't have to crush the economy to get inflation down. That's the kind of translation of that. We're just talking about transparency there. An interesting thing comes up where one of the presenters talks about, this was on the panel that you were on, the idea that there's this big difference, and I know Dom follows this, a lot of us do very closely, between how the market reacts to the statement and how it reacts to the press conference. Is that a problem for the Fed's communication in your mind?
I think they wish they didn't have to have it. There are benign interpretations, like suppose it's the case that they negotiated the statement before the meeting, essentially, because they do pass it around and they've agreed on a lot of it. Then they get together and the conversation is actually quite, more hawkish or dovish than the statement reads. Right. But rather than trying to relitigate that in real time, they just say, why don't you go clean this up in the press conference? Okay, that's a possibility. If that's right, though, you could check whether or not the minutes match the press conference better than the statement.
Right. Or is Fed Chair Powell freelancing a little bit on his own? Anyway, Dom has a question for you, Neil.
Yeah, Professor, thank you very much for joining us here. We broached this subject on yesterday's show, but there is this discussion right now about the relative situation that Americans feel right now, in that if you still have wage gains and a job, but those wage gains are not keeping up with inflation as much, is it better or worse than the possibility of losing one's job and not having an income at all? There is an interesting line, I wonder, from, maybe just an academic standpoint, about how economists would kind of reconcile or deal with that kind of a debate.
Well, I think, first of all, part of the feeling is that the level of prices is just so disconcerting to people. You're used to, a box of Cheerios costing whatever it is, and now it's 40 or 50% higher, and that's really, I think, unsettled people. So even if they don't think that the wages that they've gotten over this period have kind of kept up with the prices, they just feel unsettled about that. I think in the end, for the people that end up unemployed, that's vastly worse than just having your real wage drift down a little bit, because the next time that the market picks up and the labor market gets tight again, you can move. And it's important to realize that there's a lot of on-the-job training and human capital that you build by working. So continuing to work and not having interrupted work spells is really, really important.